Phone 1.
Okay. My name is James Claus, and I am here from New York City. Mr. Buffett, Mr. Munger, today we've already heard you talk about a few countries outside of the U.S. here, and my question is, if you were directly investing equities outside the United States, what would be your requirements for the market as a whole? And by this I mean things like the transparency of the accounting system, the breadth and liquidity in the market, the rights of shareholders, the stability of the currency. And it'd be nice if you'd mention a few of these countries. Kind of just a little addendum there is, for the companies in these countries, how relevant do you believe the reconciliation to U.S. GAAP contained in Form 20F really is?
Well, the answer is most of those points you mentioned would be of interest to us. We'd have to rule out anything where the markets aren't big enough. I mean, we are looking to put hundreds of millions of dollars into any single investment at a minimum. Certainly, we think in terms of 500 million as being a minimum. We make exceptions to that. And that's going to rule out a great many companies. Transparency of accounting and accounting rules, we care about that, but we can make adjustments mentally. In some respects, we may think in certain countries accounting is better than here. And so as long as we understand the accounting system, we will be looking toward the same kind of a discount model in our mind of how much cash is this business going to generate over years and how much is going to have to be put into it. And it's the same sort of calculation that goes into our thinking here. And here we don't follow strictly GAAP accounting in our thinking. So the accounting differences would not bother us as long as we understood those accounting differences. The nuances of taxes, the corporate governance that you mentioned could make a difference. If we thought corporate governance was far inferior to here, we'd have to make an adjustment for that fact. But I would say that in most of the major countries, the countries that have stock markets that are big enough so we could take a real position, it's a possibility that we would invest in any of them. We wouldn't rule out, Japan, Germany, France, England, the major markets. Now, it's important to recognize that in all the world stock markets, something like 53% of the value is in the U.S. market. I mean, here we have 4.5% of the world's population, but 53% of the value of all public is represented with companies in the U.S. market. So we are a big part of the pie, but we're very willing to look at almost all of the rest of the pie as long as we're talking about markets that are big enough to let us put real money into them. Charlie? Well, as we're talking about markets that are big enough to let us put real money into them. Charlie?
Well, we don't have a rule against it. What more can we say?
We can say zone 2.
Good morning, Mr. Buffett. My name is Jean-Philippe Kramers, and I'm coming from London, England. I have a question regarding Coca-Cola. The first part is, are you worried that the earnings of Coca-Cola might continue to be affected by the weakness in the emerging markets and the strength of the dollar over the next few years? And the second part is on the P/E ratio of Coca-Cola at 35 times earnings. Are you worried about the potential rise in interest rates? And is it linked to your views on inflation that you are not worried about the rise in interest rate? Thank you.
Well, in relation to the strength of the dollar, which means that profits in foreign currencies don't translate into as many dollars, we don't have any big feeling on that. I mean, if we had strong feelings about the dollar's behavior vis-a-vis the yen or the euro or the pound or whatever it might be, we could give vent to those views by actually buying or selling large amounts of foreign exchange. We don't know which way the dollar is going to go. So I have nothing in my mind in regard to any decision on buying or selling Coke that would relate to any prediction in my mind about the course of the dollar. The earnings of Coke have been affected by the strength of the dollar in the last few years. particularly the strength against the yen when when it went from 80 odd to 140 odd. That was a huge hit in terms of what in terms of yen translation into dollars from those profits, and the strength of the dollar generally would hurt. But looking forward, I don't have any prediction on that. It's in Coke's interest to have countries around the world prosperous. I mean, they will benefit from increased prosperity, increased standards of living throughout the world. I think we'll see that over any 10 or 20-year period. I think people's preference for Coke will do nothing but grow, Coca-Cola products. So what I am concerned about is share of market and then what I call share of mind. In other words, what do people think about Coca-Cola now compared to 10 years ago or 20 years ago? What are they going to think about it 10 years from now? Coca-Cola has a marvelous share of mind around the world. Everybody in the world almost has something in their mind about Coca-Cola products, and overwhelmingly it's favorable. You can't, try to think of 3 other companies like it. I can't do it in terms of that ubiquity of good feeling, essentially, about the product. We measure it by unit cases sold and by shares outstanding, and we want a lot more unit cases sold, and we like the idea of fewer shares outstanding over time. I'll be giving you that same answer 10 or 15 or 20 years from now, and I think there'll be a lot more unit cases sold then. It is true that the case growth slowed starting in the second half of last year and continuing through the first quarter of this year. But that's happened from time to time in the past. In my view, that is not it's not an important item. It may be an important item in what the stock does, in a 6-month period or a 1-year period, but we'll be around 10 years from now, and Coca-Cola will be around 10 years from now. And right now we own 8.1 or 2% of Coca-Cola, and we'll probably own a larger percentage 10 years from now because they'll probably repurchase some stock. The PE ratio of Coke, like virtually every other leading company in the world, strikes us as they all strike us as being quite full. That doesn't mean they're going to go down, but it does mean that our enthusiasm for buying more of these wonderful companies is less than it was when the PE ratios were substantially less. Ideally, those are the kind of companies we want to buy more of over time. We understand their business. This is that there's a reasonable chance, at least, that sometime in the next 10 years we buy more shares of either Coke or Gillette or American Express or some of those other wonderful companies we own. We do not like the PE ratios generally, but again, I stress that does not mean they're going down. It just means that we got spoiled in terms of how much we got for our money in the past. We got spoiled in terms of how much we got for our money in the past, and we hope that we get spoiled again. Charlie?
Like 10 years out or even further out, you don't really pay much attention to short-term economic developments in this country or that, or currency rates or any other such thing. They don't really help you in making the 10 or 15-year projection, and that's the one we're making. So we have tuned out all this noise in your projection, and that's the one we're making. So we have tuned out all this noise. Tune out the noise, and if you look at the big picture, we think Coke is fine.
It's hard to think of a better business in the world among big businesses. There's obviously companies that are starting from much smaller bases that could grow faster, but it's hard to think of a much more solid business. Zone 3.
Newport Beach, California. Bruce Lindsay, and formerly from Omaha, Nebraska. And I have a question. Some time ago I read that you were buying silver. I never knew the reason why you were buying silver.
Well, we covered the silver purchase in the 1997 annual report for a special reason. Well, it was part of a group of 3 unconventional investments we made, and one of those investments was of sufficient size so that we felt people ought to know about it specifically. And then we felt our shareholders ought to know that we sometimes do things that they might not have guessed that we would do from reading past annual reports. So we named the 3 unconventional investments. But in this year's report, we have stated that we will not be naming those investments unless one of 2 things happens. One is that they become of a size that you should know about them specifically in order to evaluate the kind of thing we do in Berkshire and the commitment of resources that has been made. Or 2, if regulatory authorities either, obviously if they require us to report it, we'll report it immediately. Or in the case of silver, a year plus ago, an important regulatory authority indicated that they'd prefer if we report it. We weren't required to do so, and our desire is to cooperate on that anyway, so we did report it. But we stated in this year's report that absent those factors, we will not be giving details on unconventional investments any more than we give any more details on our regular equity holdings than we're more or less required to do. We did say that we had changed certain of the unconventional investments that were described in the previous year's report, and we stated that we had entered into several new ones. So we are in some things that most of you, or maybe all of you, don't know about, but they aren't of sufficient size so that they're going to, in any material way at all, affect your investment. Charlie?
Nothing to add.
Zone 4.
Good morning, Mr. Buffett. Wayne Lang from Toronto, Canada. Last year, when you were asked about the year 2000 computer issue, you expressed some concerns about the cost overruns and the federal government readiness. Our 2 countries are in much better shape this year, but could you update us on your current thinking and what concerns you may have about the impact of the lesser readiness internationally on our company's revenues, supply chain, or on the stock market?
Yeah, last year I think I also told you I didn't really consider myself an expert on this, and what I tell you is just what I pick up from being on audit committees or talking to people who are a lot smarter than I am in this sort of area. But that doesn't mean they're right on it, because talking to people who are a lot smarter than I am in this sort of area. But that doesn't mean they're right on it, because my general feeling, and all secondhand, my general feeling is that the part of the world that we have to worry about is in pretty good shape. It's cost a lot of money in various places. It's cost us, some companies, it's cost a terrific amount of money, but I do not think it's going to be a big deal. And I could be wrong, but I'm less worried about it being a big deal today than I was a year ago. And Charlie, do you know anything to add?
No.
Does that mean you think it's going to be less of a big deal than you thought a year ago? Or
No, it means I have nothing to add.
Okay. That's probably what I should have said in the first place. Zone 5.
Good morning. My name is Bob Brewer, and I'm from down the road in Lincoln, Nebraska. I just wanted to ask you how you think the continuing economic turmoil in Japan is likely to affect the global economy and the U.S. stock market over the next 5 to 10 years.
Well, Charlie and I are no good on those macro questions, but I would say this. I mean, the Japan problem has been around now in financial markets and banking systems, so it's been around for some time now. So I see no reason why it should have more impact on the rest of the world now than it has had in the last few years. And I would say it's had certainly very little effect on the U.S. in the last few years. And it's no factor in our thinking at all in terms of what we would buy or sell tomorrow morning. I mean, if we got offered a good business tomorrow, unless it was directly involved, I mean, its primary business was in Japan, but if it was a business in this country, that's not something that we would be thinking about. We would be thinking about the specifics of that business. We don't really get too concerned about the things that come and go. I mean, in the end, if we're right about a business over a 10 or 20-year period, just take See's Candy. We bought it in 1972. look what happened in 1973 and 4, and all the oil shocks and what this country was going through and inflation, all that sort of thing. For us to, let's say in 1972, somebody laid out a roadmap from 1972 to 1982 with the prime rate going to 21.5%, long-term rates going to 15%, and all of the things happening, the Dow going to 570 or whatever, 560, and that wasn't the important thing. The important thing was that this peanut brittle tastes like it does, which is terrific, and that over time we can get a little more money for it. So, See's made $4 million pre-tax in 1972 when we bought it. It made $62 million last year. We don't want to be thinking about the wrong things when we're buying businesses, and that applies to marketable securities just as much as it does as when we're buying 100% of the business. If we're right about the business, the macro factors aren't going to make any difference, and if we're wrong about the business, macro factors are not going to bail us out. Charlie?
Yeah, I think what's interesting in Japan is interesting to one as a citizen. Here is a major industrial country, and they understand all about Keynesian economics and everything else. And when it starts sliding down into a big recession, it just keeps going and going and floundering and staying down, and year follows year, and you take the interest rates down to practically zero, and you run a big budget deficit, and the economy still stays down. I think this has been very interesting to the economists of the world. I don't think any of them would have predicted that as modern a country as Japan could contract for as long as it did. And I think the cause is related to the extremeness of its booms in both land prices and security prices, and the corruption in its accounting practices and in its regulation of the financial system, including banks. I think it's an interesting lesson for the world of how important it is not to let a lot of slop get into the accounting and regulatory systems, and how a lot of folly in markets doesn't help either.
Sort of fascinating to, people keep saying, well, why doesn't Japan stimulate? Well, they got short-term rates down to 0 and long-term rates at 2%. Well, that would stimulate me, but it's sort of, as Charlie says, it sort of defied a little bit some of the classical Keynesian theory on that. But in the 30s, we had the same problem in this country. We drove interest rates way down and toward the latter half of the 30s.
And I would argue that probably the extreme prosperity in America is related to this so-called wealth effect, with stock markets going up and up. And I think people thought that was a smaller factor than maybe it is.
Zone 6.
Good morning, Mr. Buffett and Mr. Munger. My name is Jeff Lilly from Denver, Colorado. My question is as follows. Over the last couple of years, I've read both of you quoted as not following the stock price on a day-to-day basis, not being terribly concerned about whether Berkshire is up or down. You now have analyst coverage. Perhaps you requested it, or perhaps you acquiesced to it. But my question is whether this reflects any change in your attention paid to the stock price or your philosophy about investor relations, and whether you think the analyst coverage is going to have any impact on the stock investor relations, and whether you think the analyst coverage is going to have any impact on the stock
price. I mean, we are concerned about building the intrinsic value per share of Berkshire at the highest rate we can, consistent with a couple of other principles that we've set forth. And we hope very much that the stock price stays in a zone that is not too wide around intrinsic value. There's going to be some zone of some sort, because intrinsic value itself is not precisely calculable. And in addition, you wouldn't expect it to track it penny for penny. But we don't want it to go crazy in either direction in relation to intrinsic value. When we made the deal with General Re, that attracted more analyst attention and institutional investor attention because General Re's shareholder base was overwhelmingly institutional. So institutions had to decide whether they were going to continue with their investment or clean it out. And we knew we would end up with more institutional ownership subsequently. Alice Schroeder asked me prior to the merger meeting. She said they were a group of institutions that were coming to the meeting, which I liked. I mean, the fact that they were serious enough about their investment to come and see what Berkshire was all about. And a few of them even had a requirement, I think, from their own boards that they at least have sat down with management. So I spent an hour or so with a group that she had put together and that came to Omaha. But that's the last contact I've had with any institutional investor. And we will have no special meetings with institutional investors or anything. I mean, they are absolutely welcome to attend this meeting to get all of the information that's dispensed. I think it's very useful, frankly, to have an analyst or two that is well versed in Berkshire and that thinks straight and does their homework. And that's a plus because it means we don't have to do it. And in effect, that if institutions want to talk to somebody about it, they don't call me because they're not going to have much luck calling me. And they can call Alice or some other analyst that wants to do it. And that's perfect. We have a non-paid. It is not investor relations because that's thought of somebody as sort of pumping your stock. But at least we have an information office now, a non-paid information office. And, that goes along the grain of my nature. And people say, do you want individual owners, you want institutional owners? What we want are informed owners who are in sync with our objectives, our measurements, our time horizons, all of that sort of thing. I mean, we want people that are going to be comfortable owning Berkshire. And we don't want people who are owning it for reasons different, in a way different, that are different from our reasons for owning. We don't want people that are concerned about quarterly earnings. We don't want people who are concerned about stock splits. We don't want people that need to be pumped up about the stock periodically. It's just not of interest to us because it just means we have to keep living that way in the future. And it's not the way we want to live now. It's not the way we want to live in the future. What we really want are a bunch of people like we have in this audience who sit down and read and think and understand that they're making an investment. It's not in this audience. Who sit down and read and think and understand that they're making an investment. They're buying part of a business. They know what the business is all about. They know how we think. They know how we institutional form. And when we get them, we like to keep them. So there's no change in our attitude about that. There is a change in coverage in that there is some limited amount of coverage in Wall Street, which I guess for a company with 110 or 20 billion of market value, there should be. We'll have one more question, then we'll break for lunch. We'll go to Zone 7, and after this question, we'll break. We'll come back in about 45 minutes or so, and those of you, as long as we see that everybody's gotten served with food in that time, and any of those who are off-site or over the holiday, I think there are buses. You can also go out and tour the Boeing business jet. We'll sell you as little as 50 hours a year, I believe, on it. So take your wallets at lunchtime. Yeah.
Good morning. My name's Mark Rabanov from Melbourne, Australia. I was wondering if you could help us out with the flight. Mark Rabanov from Melbourne, Australia. I was wondering if you could help us out with the flight operations, which are now a large part of Berkshire. I think we're still putting a lot of together in the annual report. Would help us out with what return on equity you're expecting for each of those divisions.
Yeah, the more capital intensive is the flight safety operation because every simulator costs real money, and we will add a number of simulators each year. So flight safety, you can look at their figures before we acquired them, and it's reasonable figures before we acquired them, and it's reasonable. Flight safety's return on equity is not going to move up or down by a dramatic amount. I mean, our simulator training prices are related to the costs of the simulator, and So there's not going to be way higher returns on equity, nor should there be way lower returns on equity. There is a growth in the equity employed in the business because it is a growing business, and we're training more and more pilots every year. But that'll be a fairly steady thing. The executive jet business is in an earlier part of its development, although it's the leader in its field by far. But we're doing substantial investment spending in a place like Europe, and we'll be doing that on an accelerated pace, if anything. In the end, though, our customers end up owning the planes. So we have an investment in a core fleet of planes which supplements the customer's planes. But by its nature, it's not a capital-intensive business. We are moving around a lot of capital every day. We'll have 140 or so customer planes now, and in aggregate, just to pick a figure, that those planes are certainly worth $1.5 billion or more, and we've got $7 billion of planes on order or some number like that. But we will sell those planes to our customers. So it could be down the line that it will be a business with a very good return on capital. We'll still have an investment in the core fleet, and we'll have some facilities, hangar facilities, and that sort of thing. But our customers will have the big capital investment. I should point out they'll have a whole lot less capital investment if they own their entire plane themselves. So they will be getting a bargain as well. Let's take off for lunch, and I'll see you back here in about 45 minutes, those of you who wish to rejoin us. Thank you.
Ladies and gentlemen, we'd like to remind you that lunch is being served out of the stands in the outer. Ladies and gentlemen, we'd like to remind you that lunch is being served out of the stands in the outer. If you're along downstairs, you can try upstairs. Thank you.
Okay, we're going to be ready to go in just a minute if everybody gets their seats. One through eight. One through eight. Yeah. Mm-hmm. Oh, we've got 6,000 or 7,000 anyway. Sticking around, I think. 6,000 or 7,000 anyway. Sticking around, I think. Questions wants to go to the microphone. We're going to start here in just a minute, and we will start. There will only be 8 zones from this point forward because we have everyone in attendance in the main hall. So we will rotate around 8 zones. We'll stay until about 3:30, and we'll start in zone 1.
My name is Charlie Sink. I'm from Lexington, North Carolina, as you can tell by the accent. My question relates to the General Re purchase. I wondered, I've read your letters through the years, and I've been trying to learn a little bit about investing in insurance companies. Did you buy General Re mostly because, I know mostly because of the float, because you think you can grow the float? I know it's not growing significantly now. Or did you buy it because you felt like you could do better with the investments? I've read also you felt like you could do better with the investments. I've read also that trying to get a certain amount of investments to equity. Is that something that you focus on? And that's my question.
Yeah, the first 2 parts are correct. We certainly. We don't think the float will grow rapidly in the near-term future at all. The float changed, it actually declined very slightly in the first quarter, and at a level of $6 billion or so of premiums, the paid losses are likely to run at a rate that would cause the float to remain more or less steady. So it will take a period when premiums grow for the float to grow. And the premiums would have to grow fairly substantially to have any significant impact on the float. And like I say, that will not happen in the short term. We expect the float to grow over the longer term. We expect that General Re will probably grow considerably faster in international markets than the domestic market. We think that their reputation, which was as good as could be found from an operational standpoint, from a technical standpoint, a managerial standpoint, will be further enhanced by Berkshire's capital strength. So we think their reputation is likely to grow over the years, and we think the premium volume will follow, but not in any major way at all. For a few years at least. And then we, as addressed earlier in the meeting, we think there is the opportunity to do better with that float from time to time in the future, but right now that is not a plus that it's in our hands, and it may not be a plus a year from now. We think at some point it will be a plus. We also pointed out that there could be some tax advantages to be included as part of Berkshire as well. So there are some things going for it, but none of them they will not have an impact in 1999, and they may well not have an impact in 2000. We obviously think Berkshire 10 years from now will be worth more on a per share basis with General Re included than if we had not made the deal. We don't necessarily think that's the case on a 1-year or 2-year basis, but it is our judgment on a 10-year basis.
I would say that if we in the future do as one-third as well with the new float that came to us with General Re as we've done on average in the past, it will work wonderfully. If you take our past use of float in the history of this company, it would be an interesting study if anybody ever stretched it out.
Zone 2.
Good afternoon. My name is Greg Kaza from Oakland County, Michigan. I'd like to thank both of you gentlemen for your hospitality this weekend. My question deals with price deflation. Could you please explain how technological advances and productivity increases are affecting our non-fixed fixed income holdings, especially insurance?
Well, I think that to the extent your question implies the question, how has technology affected the inflation rate, the advances in technology? I've heard Alan Greenspan make a lot of interesting comments on that. I think it baffles him to some extent, but he also recognizes that there's some important, very hard to measure factor that has caused inflation not to behave in the way that most people expected, with this drop of employment, general prosperity, etc. And I think he attributes it in some part, but again immeasurable, to what has been happening in the information technology world. Obviously, low inflation is good for fixed income investments, but that's been reflected to a significant degree in a long-term rate that's at about 5.5% now. It does look at the moment like an almost perfect world in terms of the macroeconomic factors, and that probably is a reason why people are enthused about stocks, and it's a reason, and it's a good reason in terms of price inflation. It's a good reason why bonds have behaved well over the last, really, since 1982. I don't know the answers to what it means for the future. I have to believe that it's very good for this country to have the lead in information technology that it does for this country, to have the lead in information technology that it does. I mean, it seems to me as a non-expert that we are so far ahead, and the money flowing into it, the brain power flowing into it, that it's hard to think of who's in second place, and I think that's helped this country in some very significant way, but I don't know how to measure it. Charlie?
Well, I would say that Berkshire's businesses, on average, are less likely to be obsoleted by new technology than businesses generally. No steel-toed work shoes. I do not anticipate a significant change in the technology. And I think we have more of the stuff that's sort of basic and hard to obsolete than many other corporations do.
Yeah, as we mentioned in the report, we think all of that activity is very beneficial from a societal standpoint. Our own emphasis is on trying to find businesses that are predictable in a general way as to where they'll be in 10 or 15 or 20 years. And that means we're looking for businesses that, in general, are not going to be susceptible to very much change. We view change as more of a threat into the investment process than an opportunity. That's quite contrary to the way most people are looking at equities now. But we do not get enthused about, with a few exceptions, we do not get enthused about change as a way to make a lot of money. We try to we're looking for the absence of change to protect ways that are already making a lot of money and allow them to make even more in the future. So we look at change as a threat, and whenever we look at a business and we see lots of change coming, 9 times out of 10 we're going to pass on that. And when we see something we think is very likely to look the same 10 years from now, we feel much more confident about predicting it. I mean, Coca-Cola is still selling a product that is very, very similar to one that was sold 100 10 plus years ago, and the fundamentals of distribution and talking to the consumer and all of that sort of thing really haven't changed at all. Your analysis of Coca-Cola 50 years ago can pretty well serve as an analysis now. We're more comfortable in those kind of businesses. It means we miss a lot of very big winners, but we wouldn't know how to pick those out anyway. It doesn't mean also that we have very few big losers, and that's quite helpful over time.
Yeah, the peanut brittle has very little technological change too.
They better not change it. We like it just the way it is. Zone 3.
My name is Esther Wilson. I live in South Sioux City, Nebraska. My husband and I will have some new money in the early 80s of our lifehood. We have a daughter 50 years old who will inherit anything we have. My question is I also have a 4% interest on a mutual fund that is non-taxable. Are there any better ways to invest our money?
Well, those are tough questions. I mean, I run into friends of mine all the time where they come into a lump sum at a given time, Charlie and I do not have great answers about investing sums of money for people who are not really active in the process. I mean, as we said earlier, if we were working with small sums now, we would start looking at a whole bunch of very small situations and some things that we might know how to do on a small scale. But for the average investor who wants to own equities over a 20 or 30-year period, we think regular investment in some kind of very low-cost pool of money, which might well be an index fund, probably makes as much sense as anything. But it's important to keep the costs down. I have close to 100% of my net worth in Berkshire. I'm comfortable with it because I like the businesses we own. But I didn't buy it at this price either, so I don't like to go. I never recommend anybody buy or sell it. And Charlie, do you recommend anything?
I think if there's anybody in the room who thinks it would be very easy to come up with a one-liner for a great no-brainer investment tomorrow with a great slug of new money, I wish they'd come up and tell me what it is. We don't have any solution to that one. It's harder for us now than it has been at other times.
Yeah, there's been a couple of times. In 1974, there was something in Forbes, and 69, the reverse of that situation, and then I think I wrote an article for Forbes, I can't remember exactly when it was, about how equities almost had to be more attractive than bonds at that time, and bonds weren't that unattractive. I mean, every now and then you can say you are getting a great deal for your money in equities, or sometimes you can say you're getting a great deal for your money in fixed income investments. You can't say that now, so what do you do? In terms of new money, we find ourselves sitting and waiting for something, and we continue to look. But we are forced to look at bigger ideas. So if we were working with smaller funds, we'd be much more likely to find something than we are in our present situation. As Charlie says, we really don't have any great one-line advice on it. I wish we did. Zone 4, go ahead.
The real long-term rate of return from saving money and investing it has to go down from recent experience in America, particularly equity-related recent experience. The wealth of the world can't increase at the kind of rates that people are used to in the American equity markets, and the American equity markets can't hugely outperform the growth of the wealth of the world forever. We ought to have reduced expectations regarding the future generally.
Because, we mentioned earlier 53% of the world's stock market value is in the U.S. Well, if U.S. GDP grows at 4%, 5% a year with 1 or 2% inflation, which would be a very good result. I think it's very unlikely that corporate profits are going to grow at a greater rate than that. Corporate profits as a percent of GDP are on the high side already, and you can't constantly have corporate profits grow at a faster rate than GDP. And obviously, in the end, they'd be greater than GDP. And it's like somebody said that New York has more lawyers than people. I mean, there's certain, you run into certain conflicts in the terminology as you go along if you say profits can get bigger than GDP. So if you really have a situation where the best you can hope for in corporate profit growth over the years is 4 or 5%, how can it be reasonable to think that equities, which are a capitalization of that corporate profits, can grow at 15% a year? I mean, it is nonsense, frankly. And people are not going to average 15% or anything like it in equities. And I would almost defy them to show me mathematically how it can be done in aggregate. I looked the other day at the Fortune 500. They earned $334 billion on it and had a market cap of $9.9 trillion at the end of the year, which would probably be at least $10.5 trillion now. Well, the only money investors are going to make in the long run are what the businesses make. I mean, there is nothing added. The government doesn't throw in anything. You know, nobody's adding to the pot. People are taking out from the pot in terms of frictional costs, investment management fees, brokerage commissions, and all of that. But the $334 million is all the investment earns. I mean, if you own a farm, what the farm produces is all you're going to get from the farm. If it produces, $50 an acre of net profit, you get $50 an acre of net profit, and there's nothing about it that transforms that in some miraculous form. If you own all of if you own all of the Fortune 500 now, if you owned 100% of us, you would be making $334 billion. And if you pay $10.5 trillion for that, that is not a great return on an investment. And then you say to yourself, can that double in 5 years? It can't, the $334 billion. It can't double in 5 years with GDP growing at 4% a year or some number like that. It would just produce things that are so out of whack in terms of experience in the American economy. It won't happen. So anytime you get involved in these things where if you trace out the mathematics of it, you bump into absurdities, then you better change expectations somewhat. Charlie?
Well, there are two great sayings. One is, if a thing can't go on forever, it will eventually stop. And the other I borrow from my friend Fred Stanback, who I think is here. People who expect perpetual growth in real wealth in a finite earth are either madmen or economists.
Zone 4, please.
Good evening. My name is Shru Gui Chen. I'm from Des Moines, Iowa. While we have been discussing of how much return that the company has helped us to get in the past few years and for the future too, though I believe there are many people who are concerned about how much have we given to the society in return. And gentlemen, would you please share with us about your philosophy and the company policies and how much the Berkshire has done in terms of philanthropy and charities? Thank you.
Yes, there are figures in the annual report that bear on that. One thing we did wasn't entirely voluntary, is that I think we gave about $2.6 billion to the federal government last year in income taxes. I'm not sure. I looked at General Electric and Microsoft and a couple of the largest companies. We may have paid more in federal income tax than any other U.S. company. Don't take my word for that, because it could be Walmart paid more. I wouldn't be surprised if Walmart paid more. But I did look at a couple of the big, more than GE or Microsoft, both of which have market caps that are 3 times our size. And the shareholder designated contribution program was 18 or so million, as I remember, and then we detailed the contributions in the report made by the other companies. But I would argue that to the extent that GEICO, for example, is a more efficient way of delivering personal auto insurance than overwhelmingly than its competitors are, and that if 15% is a fair indication of how much it is saving people, that on a $4 billion of premium volume, that there is something more than $600 million that consumers save by a more efficient way of distribution, which has been honed to a fine art by the GEICO management. And really delivering the goods and services that people want in an economical way is a very important part, I think, of the contribution that any company makes to society, as well as the taxes they pay and their actual corporate philanthropy. We are not big believers in giving away the money of the owner of Berkshire, acting as their representatives and giving away their money to philanthropy. We think that the shareholders should, it's their money. And if we had a partnership of 10 people, if I were the managing partner, I would not feel I should make the decisions on philanthropy for the other 9 people. I would let them all make their own decisions. We do not think that corporations generally should be passing out money to the pet charities of the CEO, and we don't do it at Berkshire, but we do let the shareholders make those designations. And as I say, I think our primary thank you. I think the best contribution actually we can make to society over 10 or 15 years is finding ways to deliver goods and services that people want to them at lower cost than the alternatives that were previously available to them. Charlie?
Yeah, well, I applaud the questioner's yearning for an answer to the question of isn't there something more in this game than making and piling up money, and shouldn't we be thinking about what we owe in return and what's going to go back in return? In the Munger case, I think 100% is going to go back in return for a reason different from that in the Buffett case. You know, there's an old saying, how much did old Charlie leave? And the answer is, I believe he left it all. And in essence, it all has to go back one way or another. You can't take it with you. That's the iron rule of the game. And I do think it's important to think about what you do for other people and what example do you set with your own life or your own corporate life. And I do think that Berkshire stacks up pretty well in that respect. And in due course, when we get into gargantuan charities bearing the name Buffett, my guess is that'll be done pretty well too. This is likely to be a pretty good run.
Zone 5.
Hi, my name is Michael from New York. First, I'd like to address Mr. Munger. Mr. Munger, it's such a pleasure to be here with you, as well as Mr. Buffett. And if you could just say hi to my wife for a second. Her name is Jane. Next, I understand your secrecy on unconventional investments, but Mr. Buffett and Mr. Munger, could you please tell me your insight on market conditions for oil and silver?
He asked you, Charlie.
We've already said that we're not going to comment about commodity investments. I will cheat a little on that. Eventually, the price of oil has to go way up. That doesn't get any money from buying it now, counting the interest factor.
Zone 6. Fortunately, I don't know. I listened carefully when he phrased his question. He said insights, and I don't have any insights, so we'll go to zone 6.
My name is Merritt Belle-Isle from Austin, Texas, and the company has a large investment in the Washington Post Company, which has many cable television systems serving non-major metropolitan areas, as well as a recent investment in TCA Cable. And so I was hoping to get a comment about the cable television business generally. And the other question is about your philosophy of children handling money and inheriting money.
The first question about cable, the Washington Post Company does have, we own about 17 or so percent of the Washington Post Company, and I believe they have 700,000 plus homes. And as you say, they're in largely in smaller areas. It's been a good business, and as you know, cable prices have been galloping here in the last year or thereabouts. From the standpoint of the Post, that's bad news because the Post would have been a net buyer of cable and will not be a seller. And it's really very much like our attitude towards stocks and stock prices. It is not good news for the Washington Post Company when cable towards stocks and stock prices. It is not good news for the Washington Post Company when cable investing funds. It's going to be a generator of funds over cable. It's way better off if cable prices go down than up. The TCA is not. Lou Simpson runs a separate portfolio at Geico, equity portfolios. So I've never read an annual report of the TCA Cable. I know nothing about it. If he still has it, it's an investment of Lou's at Geico, for Geico, and it's not something that falls under my management at all. That's a point I should mention because periodically the press picks up some item that says that Berkshire, or sometimes it says that I am buying X, Y, or Z. And sometimes that's true, but sometimes it isn't true because filings are made on behalf of various other entities that are associated with us. And I don't know anything about them. I saw one here a couple of weeks ago reporting that I don't know whether it was me or Berkshire, I think it was me personally, it was buying some real estate investment trust with the name Omega in it. I'd never heard of it. But that story appeared various places. Well, I can assure you I filed no form with the federal government that said that I was buying that stock, although you would have deduced that from certain press accounts. But various other entities, I think that there may be a subsidiary of General Re, New England Asset Management, that may have to report periodically on what they do. And since General Re is owned by Berkshire and New England Asset Management's a part of General Re, who knows what they pick up on that. So I do caution you generally to be a little careful about reports as to what is being bought or sold by me or by Berkshire Hathaway. Now, as I remember, there was a second question that I didn't like quite as well to answer. Charlie, you want to tackle that one?
Well, I think there was more interest in the future of cable. That is, we have demonstrated a signal lack of aptitude in correctly diagnosing the future of cable in a way that made us a lot of money. And we've done that in spite of the fact that in retrospect it seems like a lot that was perfectly obvious was lying around.
To date, cable has not, cable has been here for, 30 years or so. Cable has not made extraordinary returns on invested capital at all. But it's always had the promise of greater returns and extraordinary returns on invested capital at all. But it's always had the promise of greater returns, and it wouldn't have to keep investing money in it the way you have had to date. Returns will be made in cable relative to invested capital, not relative to purchase price of them, but relative to the invested capital in the property itself. And as I say, that has not really been the case. It's been the case with cable programming. Cable programming, there have been a lot of money made in relation to capital investment. But in terms of the actual investment in cable facilities, the capital investment has been such, the expenditures in developing systems have been such, that the returns so far have not been great. But the prices for cable systems now would indicate that people think that those returns are finally going to start flowing in a big way. What was the second part of that question that you had? Oh, inherited wealth and children.
Kids inheriting money.
Yeah. Well, we have a minority viewpoint down here in the front row. I think my views on that subject changed when I was about 18. Until that point, I thought it would have been a great idea. No, I am quite a believer in a meritocracy, and I think a part of that is not having people start way ahead of other people in life based on whether they were lucky enough to come from the right womb or not. So I've never been big on the idea that either society benefited or in many cases the kids, although I think that's much more problematic. But by the fact that great transfers of wealth will go from one generation to another. I would rather see the degree of talent possessed by individuals determine the resources they command in this world and their ability to influence other people's lives and command the labor of other people and all of that than any divine right of the womb. So it's and Charlie has a somewhat different view on that.
Yeah, I am a little more willing to let the world take the succeeding generations down. It's
He believes in
I don't think
passing
they need much help.
Charlie believes in passing it along as long as you're sure they're going to blow it. Okay, so go ahead.
If you stop to think, Warren, of the great fortunes of yore, if you go back to 1900, 1870, and name me the people that have vast power because they are in the fourth generation in that family. Some of them are living awfully well, but they are not running the world.
I would say the Rockefeller family had considerably more influence than if their name had been, just plain Rock.
Well, I think that's true, but you're picking probably the strongest single family of the piece. And now that it's dispersed among 60 or 70 or 80 Rockefeller, I think it's true there were 4 or 5 brothers there that had an unusual share of worldly influence. I must say in that case, I think they handled it very well.